Okay, today I'm going to start this video by saying my expectation for the CPI news was not met today. You can see the CPI news month over month having a bullish outbreak, which is better than expected, but the year over year still remains the same, meaning the inflation in the US dollar is not, the US economy is not as terrible as we expect it to have become. It is there, but it is not bad, right? However, there was something else that came out that we weren't even paying attention to as of yesterday, and that is the initial jobless claims. Now, what does this mean? People who initially claim they are jobless, let's just take a good look at it. You don't just take things off the reading. Let's see exactly what it means. It says initial jobless claims measures the number of individuals who filed for unemployment insurance for the first time during the past week. This is the earliest US economic data, but the market's impact varies from week to week. A higher than expected reading should be taken as a negative or bearish for US dollar, while a lower than expected reading should be taken as a bullish or positive. And what happened is, this is the second time in a row, right? It's weekly. This is the second week in a row we are having the initial jobless claims coming out very terrible. I mean, the first time it came out, it was above it by about 7,000. Now it is above it by, this is like a lot. This time, the initial jobless claim is almost 30,000 in difference from the expectation. So people are not having jobs, basically. Now, this is the current situation of the US dollar. And before we head into the chart, I'd like to tell you, what do you think this means? Go down to the comment section, tell me what you think this means for the US dollar. And while you're coming back here, do well to hit the subscribe button, and I'll teach you or tell you everything I know and what I think, my opinion about the US dollar currently. See you after the break. So if we look at the US dollar index on the hourly, the news came out as of 1:30, and you can see that instant bearish response from the market upon the release of such information, knowing fully well that people are not having jobs. Is actually what it means is the economy is getting quite weak, because this is it. If people are not getting jobs, people are soon not going to have enough money to buy things. And if people are not having enough money to buy things soon, then production is going to have to slow down, because supply is going to exceed demand. That brings down prices of goods, also brings down the value of things, because people will no longer want to purchase those things. It will also increase the value of some certain things, because people have little money to buy things, so people are going to value the ones they have. But all of that put together, what is happening is, it's not a good sign, right? And I'm sure you've heard of that word stagflation a lot of times. Let me just put that up here on the screen. The word is stagflation. And what does this actually mean? So I think the smartest way you can look at this word is to look at it as stagnant and then inflation. So stagnant data, stagnant job, stagnant income. People, the job space, the employment, the labor space is not so good. It's not moving positively. So it's stagnant. Today it's gaining, tomorrow it's losing. That is stagnant. That's stagnation. Now, couple that with the rising inflation. So it's more like the economy is currently in a stagnant position while inflation is rising. People are not getting jobs, and yet prices of things are going up. And this is a very, very tight situation for Jerome Powell and the entire central bank to decide whether to cut rates or to keep rates the way it is, or to even increase it. Why? Because let's do the logic behind this whole situation. If they cut interest rates, right? They cut interest rates. companies are going to have to borrow money. And if companies borrow money, not that they're going to have to, but they would like to borrow money. And when they do borrow that money, they would increase production. To increase production, they will get more people. However, because of all of this, they will increase prices of things, and that leads to more inflation. Now, if they decide to keep interest rates or increase interest rates, what is going to happen next is this. The economy is the inflation is going to stay where it is, right? Prices of things won't run up, right? They decide to keep the interest rate where it is, if it's high, because companies cannot, increase production and help the employment data. And due to forces of the fact that demand is going to drop, it means the economy is going to slow down, like seriously slow down. However, with the hope, now this is where the thing is quite risky, with the hope that prices of things are going to have to go down slowly. So either way, it is bad. Now, either way, it is bad, but this is why they employed very intelligent economics and the rest. Apart from jobs data and inflation, the central bank is tasked with making sure that the value of the economy is constantly growing. Now, jobs and inflation are two of the major parts of it, but there are other things, right? There are other things that really matter, and all those other things, they will take account of it, and then they will finally decide. September 17th is the D-Day. Let's go to the economic calendar and look at it. September 17th is the natural D-Day for all of this. And on that D-Day, we shall see, rates finally drop. Where is it? Yeah, interest rate projection. You can see it. The interest rate projections and the FOMC economic projection, FOMC statement, and then the Fed interest rate decision. Now, as you can see, the prediction right now is that interest rates will be cut, and that is like the biggest prediction right now from major economists. However, we could still be shocked, right? We could get shocked by that news. Let's see what is all in there. And you can see in the past, we have always expected it to remain the same, and it has remained the same for quite a while. And there was a time we actually expected it to go down, but guess what? Central bank held it tight at that point, and then the next time they actually reduced it as we expected. And that was way back as of September last year. Now this is another September this year, and well, we're looking at the tight position and hoping they do something good. A cut in interest rates, well, if that happens, well, it's gonna do the same ripple effect just like I stated earlier. However, it may help the economy if other factors tend to fall in line for them. If it doesn't, then they might also fall further behind. But they've done it once, right? They delayed 1 month again, and then the next month it was done. But I don't know if they'll be doing that, right? We don't know. It's the future. It's over. It's about a week away. And when it gets there, we're going to see exactly what it looks like. Moving on to other trades on the spot. Let's pull up the calculator and look at this current situation of the economy. Now, when it comes to the overall dashboard, after the release of today's news, let's filter out for today's news and release. This is everything for today's news as of now. And we only have about 5 currencies to look out for. We have the Australian dollar, which released a leading indicator, the inflation indicator, and it was bearish. For the first time, we're seeing slowly weaknesses on the Australian dollar, and you can see that in the last 14 days they are bullish, and it's now 66%, which is still good, still bullish. But if this starts to turn, then we'll start expecting the overall to tilt downwards too. Looking at the euro, what we're seeing right here is all the news for the euro today is neutral, meaning no gain, no loss. just exactly as expected, especially their rates decision is still the same. So, well, we are going to just keep saying, okay, it's moving in the direction it was moving prior to today. Looking into the British pound, we have the Thomas Reuters, and it was a bearish information. Now, this is a coincident situation, just telling us one of the set of things that is currently happening in the market, or rather in the economy. Then we head over to the Japanese yen. Now, the Japanese yen is quite neutral in total, two bearish, two bullish, and one neutral. However, they are all coincident information, and they're all similar ranked. I mean, PPI information coming out as slightly bearish for month over month, while the year over year remains as expected. The foreign investment in Japanese stock. Now, this is something you need to kind of put your mind or eyes into, and you can see that there was a very, very, very high rise, all the way from negative 785 billion plus negative, right? And then now it is positive 108.6 billion plus, which is a really good news. Foreign bonds buying, this went from 1,000 plus to 200 plus. So that was like a drop in foreign bonds. And then the large manufacturing conditions. Well, the large manufacturing conditions seems to have gotten better. You look at the previous as a negative 4.8, and then you look at the current actual, which is now positive. So the Japanese yen is mixed. Let's take a good look at this situation. Yes, you can see it is having slightly bearish, bullish, leading and lagging indicator, but the coincident information is still not in line with the situation. It's just okay, we're moving slowly. And last but not least is the big brother, right? The big brother, the US dollar, with the CPI news, which came out of, distorted my expectation completely. But the situation here right now that you really, really, really need to pay attention to is the initial jobless claims, right? Initial jobless claim, this is going to lead to other situation. It is a leading indicator telling you the economy is going good or going bad soon. And the initial jobless claim, the jobless claim for the 4-week average, both of them are very negative. This is moving over 10,000, and then this is a whopping 28,000. 28,000 in difference. Is it 28 or 23? I think it's 33k difference. Yeah, 33k difference. And then the real earnings dropped. So in other words, the US dollar is not like strong anymore. Let's see the last 14-day situation, and you can see everything that has to do with the US dollar pair. Let's check out the US dollars. Let's see where we stand against everything. And you can see some markets are really gaining against the US dollar. Markets like the New Zealand dollar, which is like very good, and then the British pound against the US dollar. We put that on the chart. Let's go to the chart and see the British pound against the US dollar. What we have here is, you can see this pullback. I like this pullback, but the spread is scary. I like this pullback. And you can see I was supposed to be in a trade, but the market never pulled back to that level. It went away from me, but this was like a trade I was hoping to come into. And I may or may not be called into this trade any point in time soon, so I may have to delete this order and wait for another setup, right? Wait for another setup to take this trade. However, just like the way I trade, right? Just in case you're missing the technical aspect of my trade, this right here is a demand zone. As you can see, that is exactly where you find my entry, waiting and hoping price is going to come back there first before it makes a move upwards. If it doesn't, I'm not sad, I didn't lose. Move on to the next trade. That is the trade idea I have right now. And then you see the New Zealand dollar against the US dollar. It is highly bullish. Let's check that out. Over here, we can see a break of trends, break of trend line. And just looking at the 9 and 20 moving averages, you can see price is now printing above the averages. So basically, what I personally would love to see is a little bit of pullback. I'm going to go into the 4 hours now and look for zones. But before I do that, I think we'll start from the daily. And this was supposed to be like a zone. However, price has mitigated it here already. Hence, I do not have like a clear zone here. But if we go down to the 4 hours, we have a lot of zones, just like this one that was already mitigated. We have another one right here. We have another one right here. And then this is not so sure. This is like a bump in the road. That is why I don't like to mark it out. So basically, price has continued printing bullish move. Now, if you want to rush into this market, you should wait for price to break through this high, right? Break through this high, and when price breaks through, you could go into the lower time frame to trade a buy order. For me, I don't see a reason to rush into markets. I just chill and let it play around. Next, we have the US dollar against the Canadian dollar. Now, this surprisingly is gaining. Why? Because the Canadian dollar is having serious struggles. Take a good look at the Canadian economy right now, and you can see it is in clear unison. The last 14 days has printed extremely bearish setups in terms of fundamental analysis, or rather macro data. It is heavy with lots and lots of negative information on their economic data. Most of it, in fact all of it, is clearly saying, well, the Canadian dollar is not a currency to sit in. And even though the US dollar is having bad, but if you look at it, the lagging indicators are not so bad. The coincidental information is where the bad issue is currently, while the leading indicators are just, just neutral compared to its overall, where it is actually bullish. So you don't expect to see movement for the Canadian dollar in this situation. You expect to see movements for US dollar, and you can see over here I have another similar trade to that of the British pound, hoping for price to come back in here and kick me in for a buy. However, I don't think this trade is viable. I don't think it's good, but let's keep our fingers crossed and see how it goes, right? Let's keep our fingers crossed, see how it goes. Next on the list for me here is the US dollar against the Swiss franc. Now, the Swiss franc, like I said, is one of the most stable economies in the world, and I'm usually skeptical to see negations on that place. However, if you look here, when it comes to the Swiss franc, we don't have like so much news. We just have the news they want us to see, and from that specific news, we can see that they have more bearish situation in the last 14 days than they have a bullish situation. Only the leading indicators are bullish, and the leading indicators may not be able to change this to a bullish coincidental information before the next 14 days, but they might still slip up into the overall graph. So in my opinion, this is not something I want to put my fingers into. Well, this is all I have for you guys tonight, today basically. I'd like to tell you thank you for watching. Do also hit the subscribe button if you do enjoy this analysis of both the fundamental, the macro, and then looking at it on the chart and saying, okay, this is possibly what we're heading for, hoping for price to do next. These are my opinions, and these are opinions formed by the fact that I'm looking at my personal bias of my own calculation of the fundamental market. It's not a go-to tool for you to jump and go buy, but if you listen to this for advice and analysis, not for advice, sorry, for analysis purposes, and then understand someone else's perspective or view, and do your own personal analysis before you trade. Thank you for watching. See you all on the next one. Peace.